All right, let's get started. Hi, everyone. Welcome to Fundera's webinar on SBA 7A loans. Today, we're going to walk through an overview of the program and give everyone details business owners should know about 7A loans during the coronavirus outbreak. My name is Georgia McIntyre, and I'm the Director of Content Marketing at Fundera. I'm joined today by Abby and Tyler, who are our Senior SBA Specialists at Fundera. They're Fundera's internal experts on just everything you need to know about SBA loans. So I'm very excited to have them walk through this presentation today. Before we get started though, I just have a few logistics to get through. This is part one of a three-part series where we dive deep into the 7A program. So please join us for part two, which is next week, where we'll walk through more details on actually getting this loan successfully. Today, though, we will start with an overview of the 7A loan program, and you'll notice at the end, we've left about 5 minutes for a Q&A session. So if you have any questions while Abby and Tyler are walking through these slides, please feel free to just drop them in the chat or the Q&A function, and we'll try to get through as many questions as possible at the end of this 30-minute session. All right, so without further ado, I'll pass it off to Abby and Tyler.
Awesome, thank you, Georgia, and I'm so excited to be with all of you guys today. So my name's Abby, and we're gonna get started here with what is the SBA 7A loan. So high level, this is one of the most popular programs in the SBA's lending options. Part of this loan, and what really is important to know, is that it's guaranteed by the US government. And so that allows for an extra layer of protection for the banks to then be able to offer you business owners the access to capital that maybe you wouldn't have in any other scenarios. There are a variety of programs within the SBA program, the 7A loans. And so you may have heard the 7A loan, small loan, a 504 loan, express loan, cap lines, veterans loans even. And of all of those programs, the 7A loan program is the most popular. So there's a number of different lengths within all those types that I said. They can go up to 25 years. With the interest rate of the prime rate plus a 2.75% spread. Fundera and our partners that we work with, the banks that are on our platform, we primarily specialize in the 7A small loan program, which has a maximum loan amount of $350,000 and goes up to a 10-year term. One thing I want to note here is that a lot of different lending institutions offer these 7A loans, from the biggest banks you can think of to the smallest community banks. And one of the things that we've done here at Fundera is we like to work with the smaller community banks because of the hands-on service and access to actually speaking with people that we have. And in turn, that makes the process much smoother for you guys as business owners. So I want to jump now and let Tyler talk us through what the 7A program looks like today.
Thanks, Abby. As Abby said, my name is Tyler. I'm very excited to be here as well. And so something to keep in mind with the 7A loan program is that this has been a program even before coronavirus was a big deal. I know there are many other different programs, relief programs released by the SBA that have been going around. These 7A loans were around before coronavirus and will continue to be around after the pandemic. This is a permanent program and it will continue to be funded. Something to know about the SBA 7A loan is that the SBA has put minimum requirements in order to qualify. So a number of credit requirements, industry requirements, and then on top of that, banks layer on additional credit requirements that must be met because banks have their own risk policies. Something to keep in mind as well is that due to current economic conditions, some banks have tightened these risk policies. So for example, some banks that we work with have decided not to lend to restaurants during this time, or some banks have decided that they raise their credit score floors at this time. The main point though is that this is more of a traditional loan. So unlike the PPP and the EIDL, which have minimal credit requirements and minimal underwriting, This is going to have a full underwrite. This is going to have credit requirements. And so there is a world where some borrowers do not actually qualify.
Perfect. So we'll jump into some of the pros and cons more specifically. Some of the pros for the 7A loan is, like we've mentioned, there is a very low interest rate in comparison to some other small business loans available to you on the market today. There's also longer repayment terms. Like I mentioned, it's a 10-year term, so that's spread over monthly payments, which leaves you with much lower monthly payments versus having it be a 3 or 4 year term. There's also no personal collateral required, and that goes back to the guaranteed portion of this, and that's one of the main reasons why banks are able to lend to you without having to put up your home, or even if you don't have personal collateral, that wouldn't bar you from being able to move forward with this loan necessarily. There's also no prepayment penalties, which is something to take note of, and it's an amortizing product, and so if you do make higher than those minimum monthly payments, then that will save on interest down the line, and it will be at no additional expense to you. There's also something to note is this type of loan helps build your business credit, which not all loans do that for you. And so if you're able to get an SBA loan, it's seen as very positive to other lending institutions and can help grow your business's capacity to take on other types of financing in the future. You also can have multiple 7A loans. I'll just touch on that. And it's actually, banks are okay with that. There is a similar underwriting process for a second or third one, but we've seen multiple businesses come back and be able to take on additional 7A loans. Some of the cons that we want to highlight is there are specific qualifications, which we will touch on in the next slide here, that have to be met as bare minimum set forth by the SBA institution as well as the banks. There are longer processing times than maybe some traditional or online loans, and that's because this is a hands-on underwriting process. There will be a person both on Fundera's side and the bank side that will look through all of the documentation that is provided and do an official formal underwriting process. Then there are also some restricted uses of proceeds, and that's really what, working with us, we can help make sure that your business is being presented in the best light possible and that you are using this loan for an eligible use. And most of those uses, which we will touch on in a moment here, are related to expansion for your business or growth or refinancing, that type of thing. One of the things I just wanted to touch on is when it comes to refinancing, just to put it in perspective a little bit, is oftentimes or sometimes businesses need to take on some high interest debt in order to accomplish the projects they want to accomplish. And so one of the most gratifying things for me and what this SBA loan can do for you is that in refinancing some of those higher interest debts, I've seen business owners go from paying $15,000 in monthly payments down to $4,000. And that is just pure cash savings on a monthly basis. So that's something that is really, really good for businesses. And so at Fundera here, we've seen how some of those cons, like I mentioned, the qualifications, the longer processing times, just the confusing clunkiness of the process has impacted business owners from being able to secure these loans. And so that's why we actually have dedicated a team of experts that you will be paired with as you go through the entire process. So if that goes starting from the pre-qualification stage to the application, to then moving to the bank underwriting and ultimately bank closing, you'll have a person, an individual person on my team that we can do this together, so you're never left alone in this process.
That all being said, a good question is the 7A loan a good option for you? And I think the best answer for that is that the 7A loan is perfect for mature businesses that need capital to execute on growth plans, cover future operating expenses with working capital, or refinance more expensive business debt. In other words, some of the qualifications that we find in applicants that get approved are a good personal credit score. By credit score, I mean a FICO score. The average national credit score was about 692. So plus or minus from there is a good range. You also have to be profitable. And so our banks do look at how much cash flow your business brings in. They want to see some profitability so that you can pay back the loan on time. This goes into the next point, which is an acceptable debt to income ratio. Our banks have specialized debt to income ratios that we can calculate to see if you would qualify. Businesses that have large amounts of debt on the books, unfortunately, have a harder time qualifying than businesses that are relatively debt-free. 2 years in business is a strict requirement that the SBA requires. Unfortunately, this is not a great loan for startups. There are other SBA loans out there for startup businesses, but in order to qualify for a 7A, you need to be in business for at least 2 years. And then finally, and probably one of the most important qualifications, are that you need a demonstrated need and a use for funds. We often have borrowers come to us that don't have a specific use in mind. They kind of just want money. And I understand that right now in uncertain times, many people just want to build a buffer of cash in order to get through the next few months. And that's understandable. However, the SBA gives very strict guidelines to our bank partners that they need to lend money to borrowers that have specific uses. And by specific uses, I mean specific debts they may want to refinance, or specific working capital cases such as payroll or rent or utilities or growth plans that they want to execute on. We unfortunately, and our bank partners unfortunately, cannot give borrowers money just for an additional buffer because they do need to know where that money is spent. Something else to keep in mind is that there is also a demonstrated need, which we will go into in the next slide. But if you were able to secure financing through other means, such as PPP and EIDL, and you may have already cash on hand, you will need to show a need for this 7A loan and show why you need additional financing from the SBA. We are good with working borrowers through this, but it's also something to keep in mind. So some considerations, as I said, if you were able to receive an EIDL and a PPP, is that it might affect your eligibility. Just to throw some quick definitions out there, the EIDL was a COVID-19 relief financing option. They're still accepting applications on a limited basis to provide relief for negatively impacted businesses. Same thing with the PPP loan, the Paycheck Protection Program. Businesses can borrow 2.5 times their average monthly payroll, the max loan amount of $10 million. These are two relief options. And so these have minimal credit requirements, not much underwriting, and really was just trying to get money into the hands of business owners as fast as possible. This differs from the 7A loan, though. The 7A loan, as touched on before, is a traditional loan that will have credit requirements and will have different aspects of it that are a little bit trickier than these two programs. The general guidance we have been given from our bank partners is that if you received both an EIDL and a PPP already, you are going to need to show in further formats and in further needs of why you need the 7A loan. In fact, some bank partners have decided not to lend a 7A loan to a borrower that's received both of these, but we do see it being a little bit more challenging.
Thank you, Tyler. So just to recap where we've gone through in this presentation. So the 7A loan is a permanent program. This is existed before COVID-19, and it will continue on even as these more temporary relief financing options go away. And it's primarily for mature businesses who have a profit. And then, like I said, that once the EIDL loan and the PPP loan do run out or that program closes, this will still be the best option for business owners. And so that's what we wanted to do today, is just provide some context, high level, of what the qualifications are. And we'll jump into more specifics in our upcoming webinars.
All right, thank you so much, Abby and Tyler. We have some time for some questions that you guys have been submitting. And so I'm just gonna start handing those off to Abby and Tyler, and we'll get through as many as possible. So the first one to cover, maybe for you, Tyler, is Is the 7A loan more or less strict than the COVID-19 relief financing options, being the PPP loan and the EIDL loan?
It's a great question. So the way I would look at it is it depends on how you look at strict. It is more strict in terms of how to qualify for it. So the PPP and EIDL loan, those did not have any credit requirements. They did not have any cash flow requirements. You just had to do a quick calculation, and then they were able to wire funds to your business as soon as possible. As far as what you could use it on, the PPP is pretty strict as to what you can use it on, which is payroll, essentially. The 7A is a little bit more lenient when it comes to the use cases. However, when it comes to qualifying, a 7A loan is going to be harder to qualify for and more strict.
Awesome, thank you. The next question for Abby is, what's the main difference between the SBA 7A loan and the Main Street loan program?
What a great question. So again, this is similar to the EIDL loan and the PPP loan. Is the Main Street lending program is something that has come about as a relief effort for business owners due to the economic impact of coronavirus. And so what that also is focused on is actually geared a little bit more towards bigger businesses, bigger in size and top line revenue. And so with the 7A loan, there's much more, or that's more of where our focus is going to be as looking at smaller type businesses, and we'll continue on into long after the relief financing has been taken care of.
Great, thank you. So the next question is, can this loan be used to buy real estate? And is this something that would be useful for purchasing some real estate assets? And I'll pass that one to Tyler.
Yeah, that's another great question. So the 7A loan is not a loan that should be used to purchase real estate. There's a specific SBA loan for real estate, and that's called a 504 loan, which has different requirements, and it's something that Fundera does not really work with. But the 7A loan is going to be used for working capital and refinancing business debt.
Great, thanks, Tyler. So for you, Abby, we have another question. This business owner has a situation where they've defaulted on an SBA loan before, and they're wondering if they could apply for a new SBA loan for a different business, or will that previous bankruptcy for the other business disqualify this borrower from any SBA loans in the future?
Good question. So yeah, anytime that there has been a default on a government-backed loan in any case, that is going to be an automatic disqualification for future SBA financing. That's something that the SBA takes very seriously, and it's not even up to the banks themselves, but that's just something set forth by the SBA.
Got it. Thank you, Abby. That's helpful. So another person has a question. This person actually already has an SBA 7A loan, and they're wondering if it's easy to refinance this loan. Tyler, can you take that one?
Sure. So you cannot actually refinance SBA debt with another SBA loan. So directly, I would say it wouldn't be easy because it's technically not possible. That being said, sometimes when our borrowers do get additional capital through the SBA, while they don't directly repay their existing SBA loan, they use this new SBA loan to free up some cash flow. And then that freed up cash flow then can go towards paying down your existing loan.
Got it. Thank you. Next question for Abby is, this person has recently opened their LLC, but they've been operating as an independent contractor for about 20 years. How would you recommend, Abby, this person go about thinking about getting an SBA 7A loan, and would this person even qualify?
That is a great question. So like I heard that you've been operating as an independent contractor and you are now an LLC. So one thing that the bank will take into consideration is there is that 2-year minimum from doing business, but if you were operating as a sole proprietor, then they'll still consider that as the business that you have the business experience to do that. So what I would start by doing to explore this SBA financing for your new LLC would be to look into, or basically to reach out to Fundera and start filling out an eligibility questionnaire, which is something that we'll follow up with in the follow-up email, I believe. And that questionnaire will help provide some additional questions to help see if you are still qualified for this SBA loan in the near future. Tyler, do you have anything to add to that?
The only thing I would add to that is we have seen banks take different stances on this. As I said earlier, the SBA gives their guidelines and then banks layer on their own set of guidelines on top of that. And with that, banks interpret the SBA guidelines differently. So while one bank may see you as a business owner for 20 years, another bank may take a more strict approach and view it as your LLC has not been around for 2 years, so you are not eligible. So it's really going to be a bank by bank interpretation.
Great, thanks both on that. Another question we're getting is, what is the minimum credit requirement for the SBA 7A loan? Tyler, I think this is best for you. You mentioned there's a range. I'd love for you to talk a little bit about that.
Sure. So once again, going back to my previous point, there's SBA guidelines and then there's bank guidelines on top of that. The SBA requires a minimum credit score of 640, and that's going to be a FICO score. However, we have bank partners. In fact, most of our bank partners actually do require more than that, between the range of 650 and 685 being the minimum FICO score required. Also, you may have heard in the news the term E-Tran. E-Tran is a business score that the SBA generates. E-Tran did not matter for PPP loans, but you do need a minimum E-Tran score in order to get a 7A loan. So
Great.
That being said, there's not an easy way to know your score. You would only know that until you apply. But the best guidance I can give is over a 640 credit score is going to put you in a good starting position to qualify.
Great, thanks, Tyler. Next question for Abby is, if you get a 7A loan, will the interest rate be the same regardless of which bank lender you go through?
Great question. So the interest rate there are guidelines that the SBA sets forth. It's like there are maximum interest rates that a bank can charge. And so in short, the answer is any bank that you work through with us will be the same. And for most cases, it'll be the same. But there are some ranges. There's some flexibility depending on what that interest rate looks like. But what we do is we actually make sure that there's the lowest interest rate available to you, which is the minimum spread that's added, which will take the Wall Street Journal prime rate and add the 2.75% spread. And that will remain constant throughout the entire life of the loan.
Great, thanks, Abby. Tyler, would banks ever consider looking at personal income when making a decision on approval for an SBA 7A loan?
Sure. So when looking at cash flow, they look at your business income, your business cash flow, your business debt, but then they also look on your personal income and your personal debt. So in short, yes, banks do consider your outside income. The way I like to think about it is your business needs to stand on its own within their guidelines without any personal income or personal debt. And then they'll layer on top of that any personal income and personal debt you may have. So we often see borrowers that this helps them because they have some outside income that really can support the personal debt they have. But we also see many people unfortunately get declined because of this, because they have little to no business debt, but they have a good amount of debt on the personal side. And so banks take into consideration both sides.
Got it. Thank you, Tyler. Another question coming through for Abby is, what are the fees to the borrower for the SBA 7A loan program? does the borrower pay Fundera, or does the borrower ultimately pay the lender?
Yeah, that's a good question. So this again is going to be bank specific, but in general, what I can say are the fees are pretty standard throughout, and these again there are minimum and maximum fees that are set forth, and what that looks like is it ends up being around, rule of thumb is it's going to be about 4% of the overall loan that is considered an origination fee or application fee. And that'll be taken off the top of the loan at the time of funding in all cases. So it's no out-of-pocket cost to yourself. But that will go towards, that's not, part of that fee is broken down into two sections actually. And part of that will go directly to the SBA to basically subsidize the cost of this loan program and to be able to continue offering the benefits of the program to business owners. And then the other part of that is the packaging / application fee that is actually paid directly to the bank. And so Fundera doesn't collect any money from the business owners. There's partners, or there are different partnerships that we have set up with our lending partners so that we have those things worked out on the back end.
Great, thanks, Abby. Tyler, this is a good question for you. The last time this borrower applied for an SBA loan, there were a lot of restrictions around this person's lease and guaranteeing the length of their lease. Would that still be an issue in the SBA 7A loan application?
That's a great question, and I actually will turn to Abby on this as well. But the SBA does require banks to get something called a landlord subordination. And what this does is it allows the bank to recover assets should the borrower default on the loan. They also require an option to renew. And what this does is it guarantees that the borrower or in the business will have a place to do business for the life of the loan, which is 10 years here. If you come into issues with that, we found that some banks are willing to waive this requirement while others aren't. And so it really is a bank by bank issue that it could come up. That being said, it is an SBA requirement that banks need to waive on an individual basis. And Abby, if you have any more insight onto that, I'm sure I'd be happy to hear.
Yeah, no, I think you covered it. If there's been historically some challenges with that, it's most likely because you qualified at a bank that had more rigorous requirements and we were unable to get that waived. And that is because we touched on there's no personal collateral with this. There is going to be a blanket lien placed on your business assets. And that's the primary reason for the landlord subordination and the option to renew. The bank just wants to confirm that throughout the length of the loan, the 10-year length, that you'll have a place to do business, especially if your business is very site sensitive. That's where they're less lenient on waiving that requirement. Whereas if you're not really a site specific business, which there are many businesses now which have proven they can go remote, then the bank may be more open to waiving that requirement, but it is on a case-by-case basis.
Thanks both. One other question we're getting is, for Tyler, is it best to use the SBA 7A loan to refinance existing high interest debt, or would you recommend using the SBA 7A loan for hiring new employees?
That's a really good question. Refinancing existing debt is one of the best uses, in my opinion, of this loan. We've seen people, as Abby mentioned, go from $15,000 to $20,000 a month payments with short-term expensive debt to less than $3,000 a month. And so that kind of cash flow and those savings unlock a lot of potential for your business. That being said, there are requirements in order to refinance debt. And I won't get into all of the very detailed requirements here. However, something to keep in mind is the debt that you used, the original debt that you used needs to be used for an eligible SBA purpose that you are going to refinance. So in other terms, you can't refinance debt that was used for SBA ineligible uses. A common theme for this is debt that was used to pay taxes, unfortunately cannot be refinanced. And so that is when you could decide, okay, should I refinance this debt, or can I refinance this debt, or should I use it to pay employees and hire employees? if the debt is eligible to refinance, my personal opinion is it's probably good to refinance that debt and get some of that high interest debt off your books.
Great, thanks so much, Tyler. Looks like we have time for one more question. We'll just squeeze it in here. Abby, how do you know and find your E-Tran score?
Yes, that is a great question. And that is something that only banks are allowed and able to access for us. Banks have a designation called PLP, or preferred lender, basically. And so they have access to the SBA system, which generates the E-Tran score. And so it's really, you'll basically find that out as we go through the SBA application process. That's part of the pre-qualification that is done as we submit your application for like a pre-check with the bank. We'll check to see what your E-Tran score is. But a good indicator is we do know that it is tied to your personal credit as well as your business credit. So if your if your personal credit is in the high 600s or above that, then there's some indication that you will have a positive E-Tran score, although I'm hesitant to say that because it's not directly tied. So the best way to go about getting that is seeing if you meet all the other qualifications through the SBA program, and then go through and try to apply. And that is a soft credit check, so that would not negatively impact your personal credit score in any other way.
All right, thank you so much, Abby and Tyler. We are at time. So thank you so much for joining, everyone. A quick reminder, just to sign up for part 2 with the link that we'll drop in this Zoom chat. Part 2 will dive into way more specifics on the application process. So a lot of the questions you guys were sending, we'll get to in part 2. We'll also be following up in your inbox with that link. So no worries if you can't get it here, make sure you register via your email. Additionally, if you're interested in learning more about Fundera's SBA application, check out the link that we'll drop again in the Zoom chat to understand your eligibility and kind of get in touch with Fundera's SBA team. All right, thank you so much for joining, everyone, and we'll see you next week for part 2.